Hi, this is Professor Kiss. I'd like to talk to you about a concept called beta. We've determined that we can diversify away some risk, the diversifiable risk, the unsystematic risk, the firm-specific or unique risks that are specific to a particular firm or company. An example occurred in 2009 to 11 when Toyota had a recall automobiles which might accelerate when drivers wanted to slow down. Okay, that's Toyota stock falls due to that recall. Maybe the entire industry will perform badly if customers think that other cars may have that problem. But that recall will not affect the overall economy. We cannot diversify away systematic or market risks, things that have impacted the entire economy, like a change in GDP growth or interest rates. In a recession, demand declines for almost all assets. Market risk is what's important. How do we measure it? And the answer is we're going to use a measure called beta to tell us how much market risk we have. And that's going to be the important factor in terms of pricing the security. What is the security's beta? That's going to tell us how much risk the security has and therefore how much risk we should expect from that security. We can look at historic returns for a stock versus the market, and that tells us how well a security is doing relative to the market. Is it moving more than the market or less than the market when the market goes up or down? If the stock has more swings in return than the market does, that stock has a beta of greater than 1. The beta of the overall market portfolio is 1. You can think of a beta of 1 as representing an average exposure to systematic risk. The risk of an average stock is 1. The beta of the market is 1. The beta of a stock that moves more when the market is going up or down is going to be a beta greater than 1. If it moves less than the market, its beta is going to be less than 1. Some companies are less sensitive to what the overall market is doing. In general, utilities have low betas. Even in a recession, you will still turn on some lights. Beta of Consolidated Edison, symbol ED, for example, equals 0.15. On the other hand, betas of resort hotels tend to be high. In a recession, people spend less on travel. Beta of MGM is 2.45. Typically, betas are estimated from historic returns. We look at what the stock prices were in the past and calculate the stock returns in the past and compare it to market returns over the exact same period and see how this particular stock has done relative to the market in that time period. Often we use the S&P 500 to represent the market. Typically, you'll use 5 years of monthly data, monthly stock returns versus 5 years of monthly S&P returns. But you don't need to calculate betas using a regression in this course. There is an optional video in the video resources section of the course called How to Calculate Beta Using a Regression. If you run a regression using Excel, you'll plot a bunch of data points, and Excel will fit a line to those data points. The slope of that line is the estimate of beta, and that slope tells us how much on average you are seeing the stock's excess returns change for a 1% change in the market's excess returns. How do we relate market return to risk? Market risk to return? Beta is going to be our measure of the market risk or systematic risk, and we are going to use this equation on slide 5. It's called the Capital Asset Pricing Model, CAPM, that the return for an investment is equal to the risk-free rate plus the beta of that security multiplied by the market risk premium per unit of systematic risk. Now, what is that risk premium? Typically, that risk premium is the return on the market minus the risk-free rate. In some problems, you'll be given a market return and you'll subtract the risk-free rate to get the market risk premium. In other problems, you may be given the market risk premium. But basically, that market risk premium is the price that everyone pays for risk. Only the common risk, the systematic risk, determines expected returns. A firm's specific risk is diversifiable and does not generate any extra returns. You can stop, pause the video, and read the problem on slide 6 from the textbook, which shows how to calculate the beta on slide 7. But what we are interested in is in slide 8, using CAPM. You can see that investors require an expected return of 8.1% to compensate for the risk associated with this stock. So let's turn for a minute to the Excel, new share here. And you can see here's the equation, and now I will calculate the return on the stock using the capital asset pricing model. First, I have calculated the market risk premium by subtracting the risk-free rate of 4% from the return on the market of 10%. Now I use the equation equal to the risk-free rate plus the beta of the stock multiplied by the market risk premium, and get here a return on the stock of 8.1%. Let's go back to our PowerPoint for a minute. On slides 9 and 10, I show you a problem from the textbook on using negative beta. If you can find a negative beta stock, it can provide recession insurance in a well-diversified portfolio. There is a linear relationship between its stock's beta and its expected return. The security market line, SML, is graphed as the line through the risk-free investment and the market in slide 12. The beta of the portfolio is the weighted average beta of the securities in the portfolio. You can see a sample problem on these slides 13 to 15, and I have worked it in Excel. So let's look at the Excel. Here we see that Kraft has a beta of 0.5. Boeing has a beta of 1.25. So we can calculate the return here on Kraft 4% plus the beta 0.5 times the market risk premium of 6, and that gives us a return of 7%, 0.07. For Boeing, with the higher beta of 1.25, the required return is 11.5%. Now, how can we get a return on a portfolio that is 50% of Kraft and 50% of Boeing? Well, one way we could do it is multiply 50% of each of the returns and sum them, and I get 9.25. But alternatively, we can find the beta of the portfolio. Again, using the 0.5, it is 50% of 0.5 weight and 50% of 1.25, so that the Boeing of the beta of the portfolio is 0.875. Now we've got that 0.875 here with the portfolio. Now let us see what is the return on that portfolio. The return on that portfolio is the risk-free rate plus the beta of the portfolio multiplied by the market risk premium, again 6%. And you can see I get the same answer, 0.0925 is a decimal, and if I want it as a percent, I can show you that I get it as a percent. So now you know what beta measures, what a beta of greater than 1 or less than 1 measures, and how to calculate the return of a security using CAPM, how to calculate the beta of a portfolio, and how to calculate the return of a portfolio.